You already told us what would mark the day. You said it long before the fever and the rage. Lift your eyes, I'm with you to the end of the age. When the sun grows dark and the stars all lose their place, still your word stands steady at the end of the age. At the end of the age.
Welcome back to episode 7 of the End of the Age podcast by Witness to All the Nations. Patrick, why did you decide to call this episode Economic Quakes, Bonds, Oil, and the Coming Shaking?
Well, I was looking at some of the news stories. So when we're talking about the geopolitical news cycle and the news stories, and some of these major news stories had to do with things that are really big items when we're talking about economics or finance. We talked about in some of the earlier episodes on the backgrounds that we came from,
Right,
and some of the indicators. And I was talking about finance and economics. And so when I was looking at a lot of the news stories surrounding the oil price, when I was looking at a lot of the news stories, then I was looking at some where we were talking about bonds.
Yeah.
A lot of the bonds and the yields in particular were being raised in the bond markets. And sometimes I was even seeing currencies around the globe that were plummeting, like Turkey. And I was saying, man, these are tremors. And that's why we named the episode the way it is. This may not be the big quake,
right,
the big economic bust that we see in like Revelation 6:6. I don't know if you remember, all the listeners who've been watching the episodes, we talked about Revelation 6:6. There's going to be a time even where this hits the economy at the very end of the age, the global economy. And we can see that in Revelation 6:6, where it says that a day's wages will be for like a loaf of bread. And it's because it's using things in there like grain and barley. And so not only in that do we see that in that verse, but we also see in that verse where there's going to be a large disparity of wealth between the rich and poor. And we talked to you about the wine and the oil, and that's what it means there. So we have this huge economic impact where a day's wages will be to purchase a loaf of bread.
It's just crazy.
Or it's just crazy, right? Or a large disparity of wealth between the rich and poor. And we're not saying, and I would say that's the major earthquake.
Right.
That would be the major global economic shock. Yeah,
that's good.
That we're waiting on. But I would say these are just tremors. Mm-hmm. These are just little quakes, sort of like those forequakes or those tremors that happen beforehand, before the major economic shock. And so we're going to tell you why a lot of these things that are happening in your news cycle are correlated or relate to one another.
Right.
And so we're going to try and build these down. We're going to try and explain this as easy as possible. Like Amanda said, we're just trying to make hard things easy. And if you remember, part of the podcast, if not the main thing of the podcast, is not only to teach eschatology, but to relate those eschatological knowledge. Once you get that eschatological knowledge, is to correlate that or blend that with your news cycle.
Exactly.
Geopolitics and the news cycle. And so we haven't done that a lot, but we're seeing some of those things. And so that's what we're going to do in this podcast. And I think that me and Amanda have talked, and I think the best way we'll do that is Amanda's going to act like a proxy. So she's going to act like the proxy, like she's you. She's the listener, and she's going to ask these questions. And we're going to try to explain them to the best of our ability. We're going to try to make hard things easy, try to explain sort of in-depth things simply,
right?
Make them easier to understand, and how there is a correlation between them, and that you can be aware of these things. Mm-hmm. And so that you can look in your news cycle, or you can watch these things and be a little bit more aware of those and how they may relate to later eschatology.
Yeah, and I think we're going to also provide some aids, to help with that as you're speaking, so that people can see, what we're talking about and what's going on. It helps me, because I don't understand the economic stuff myself, and I think it's imperative that we do know it and see how it's affecting what's going on, and how that gives us a biblical perspective about what's going on. So I'm glad that we're doing this because I'm not as informed as you are. And so I'm super thankful
100%.
that you're willing to do that.
Yeah. No, and if you don't know Amanda, like, yeah, she may talk like all she knows is some medical stuff, blah, blah, blah. But she was a huge leader as well before we became missionaries. She ran a whole bunch of doctors and offices. So she knows the importance of visual aids as well. It's not like I'm the only person. So we're going to try and do that. We're going to probably try to put up these visual aids, try and put up these slides up there for you to see so that some of this will make a little bit better sense for you.
Okay. So if you don't mind me asking you a couple of questions and then, you answering this. Okay.
Absolutely.
All right. So my first question is, what happens when energy costs rise?
Absolutely. So that's one of the reasons, if you look at the episode title, why we put bonds oil, right? And the coming shaking is because oil is just energy, guys. So when we're talking about the energy market, we're talking about oil, we're talking about natural gas, but guys, those are critical.
That's right.
Those are critical to every single facet of the economy. When we're talking about, hey, crude oil is what makes gas, and gas is what you put in your car. So the everyday person is going to care about the crude oil market because it's going to come out in their gas prices. And it all matters to us how much we pay in gas to get to work, how much we pay in gas to go for if we're doing a hobby or something on the weekend.
Right.
It's going to all matter how much we pay in gas. Well, guess what, guys? It also matters to businesses.
That's right.
How much they're paying in gas. It also matters for electricity when we're talking about natural gases from a business standpoint. So this is not just our own personal gas, but this is also what makes your bread go up in prices, guys, because this energy, how it causes inflation is, hey, here's what the business is going to do. The business is going to go, look, if it's going to cost me more to ship something, guess where that cost gets put to? It gets to the consumer. Yeah. Absolutely.
Yeah.
So when shipping costs rise, when electricity is higher, when gas is higher, all that supply chain and those logistics of shipping something, all that gets transferred over to the consumer. So this is not only going to come out in how much you pay for gas, but also how much you pay for groceries, how much you pay for bread. And so this rise in costs all over is what is going to lead to inflation.
Oh, that's a good point. So if you want your products to come to you, by air, land, sea, how they say that, air, land, sea, all that costs gas, to get there.
Market,
all the energy market. Yeah.
That's right.
Okay. So my second question is, how does that feed into inflation stress?
Well, I think I just kind of answered that a little bit, that's what the energy market leads to, inflation stress. But I'm going to double down on it even more. I'm going to throw a slide up for you that shows you some of the choke points. So if you'll look at the slide that we produced for you up there, you're going to see in this slide that some of the biggest choke points for how we get that energy to you, that crude oil to you, is in your news cycle right now. You've probably, if you've turned on news, you'd say, wow, my news is all about Iran. It's Iran, and this war in Iran. But why? And why are this Strait of Hormuz? What is going on with this Strait of Hormuz? But I want you to look at this slide up here, because it's not just the Strait of Hormuz, but it's also this Bab el Mandeb. It's also this Suez Canal. This sort of waterway, this maritime shipping channel up here, is how we get a lot of our goods to us or to you or to different parts of the world. And so not only energy, not only crude oil, not only natural gas, but if this was to take a different route, if this was to take a route around Africa, it would increase shipping times.
Correct.
And also some of the things that make this be more costly is anytime you ship something somewhere, there's an insurance cost to it. And so when you're talking about these energy markets, you're talking about things that get traded in a futures market. And so this is one of the questions I think people a lot of times would ask. They would say, hey, why why I get it a little bit that there's these choke points on shipping. And this is one of the bigger producers of energy in the world here in the Middle East. So I get a little bit of that. I get, here, this is sort of the Gold Coast here at the bottom portion of Saudi Arabia. And, I see that Iran and Iraq and a lot of these people, when we're looking at Kuwait, a lot of this oil comes from there, but they'd say like, what does that got to do with us in America?
Yeah,
They
good
would
point.
say,
Good point.
they'd say, isn't America one of the biggest producers of oil in the world? Why does it matter to us what's happening there? And I get, Patrick, you're saying there's choke points here, and so that this can get to us quicker and it doesn't have to go all the way around Africa to get to us. But why does this matter? Well, guys, this matters so much because if you would have seen early on in this conflict, even Great Britain and other countries were trying to battle when, I don't know if you remember, when Yemen has a proxy from Iran in it, the Houthis. And when the Houthis were attacking ships there,
Yes.
they were trying to get goods to us. They were trying to keep it from going up through these straits that pass all along through here to get it to the Mediterranean Sea. Because if you can get it to the Mediterranean Sea, then you can get it to Europe, and then you can get it to the rest of the world without having to go through Africa. But that's why Trump was so, upset about it. That's why other leaders, like I said, in the UK and stuff, were so upset about it, because that's going to rise costs.
That's right.
Because those are going to be extra shipping costs that come to you. And that's why it was a big deal, because these are goods, not just energy goods, but any goods. If they have to go a different direction, that's going to drive costs. And when those costs get driven up, it's going to drive inflation. But I just want to go back to, well, so why though? Why, if we are such big producers of energy, why does this even matter what's happening over in the Middle East? Well, I want you to look at this other slide that I have up here. And this other slide I'm showing you here, that America is one of the biggest producers of oil or even energy. Let's just say energy in the world, because we got a lot of shales. We do fracking. We got shales that have oil,
Right.
large oil reserves, crude oil. We have large energy shales that just can produce natural gas and energy. But in addition to all that, the problem is, guys, number one, we're also the biggest consumer in the world.
Exactly.
You'll see them I have up here that we're one of the biggest producers of energy in the world, but we're also one of the biggest consumers of energy in the world, if not the biggest. And so not only is that a factor or a variable in here, but two, I'm going to reiterate the fact, but guys, it is priced globally. So it is priced in a futures market. So the energy market is a futures market that is looking at these things. It's looking at, hey, what is the future going to be like? And they're looking at a whole bunch of things: geopolitics, wars. They're looking at natural disasters and things like this that ends up making them price these out.
Oh, good point.
And I think everybody, every business would do this. Your local grocery store, if they know that their supply chain just got messed up for eggs, and they're not going to be able to get as many eggs, then they're going to raise the price of eggs.
Right.
If they're in the Gulf, let's say the Gulf of America, Gulf of Mexico, whatever you want to call it. If you're in the Gulf and all of a sudden there's a hurricane coming on the horizon, they're looking at these factors. They're looking in these future factors in order to price these things out. So then all of a sudden, let's say they wouldn't be able to get you some natural gas or some energy from that area because of this hurricane, or they can't have people out there extracting this energy. Mm-hmm. If they can't do that, they're going to take that shortage of supply or shortage of labor into factors, and it'll be priced accordingly. And so that, I just think people would have that question. I've seen that question online. They say, well, why this and that? Well, I just want to say again, it is a future. The energy market is a future market that takes into account geopolitics, shipping issues, production issues. All those go into pricing out oil and gas around the globe.
Oh, that's a really good point. Okay, so when inflation is high, what do central banks do with interest rates?
That energy caused an issue in inflation because, like we said, that gets passed on to the consumer. Well, a lot of times you'll have these things. I'll try to explain this as easy as possible. inside a country, let's say you went to grad school, you went to get your MBA or something, and they're going to do an economics class at the beginning or something, explain to you how this works. But most countries have a central bank. And
Okay.
so, and ours in America is the Federal Reserve, but
Right,
they'll have a
right.
central bank.
Okay.
So you have these central banks all around the globe. And this central bank, one of the things that it does, one of the biggest things the Federal Reserve does, is it controls two things. One of its biggest objectives is to make sure employment is robust
Okay.
and unemployment is not high. And number two is to make sure the thing that we're talking about, inflation, is not too high. So they don't want unemployment to be too high and they don't want inflation to be too high. And the way they control a lot of that is through raising interest rates. And then a lot of central banks, like the Federal Reserve, have a main interest level or a main interest rate. And in America, it's called the federal funds rate. And so we have this federal funds rate that dictates borrowing. And if we could slow down borrowing, then we can slow down inflation.
Okay.
Because I think maybe I've mentioned it to you before, but when there's more money out in circulation, then the price of things is going to rise.
Right, right.
So, and we've used an analogy. Let's say we go to Johnny on the street. He's selling apples. And he's like, I'm going to be an entrepreneur and I'm going to sell some apples. And so he's got these 4 apples he wants to sell. And we walk up and we all have $1. Well, and he's going, he has to price these out, right? And so he said, well, maybe I'll charge $1 because there's $4 out there and I have 4 apples. So I'm going to charge $1. Well, he may price them differently if we each have $20. If we each have $20, he may charge $5 for each one of these apples because there's more dollars in the group, in the market that's coming to look, those consumers that are coming to look at his apples. Well, it's very similar to use that analogy for the economy. If there's more money floating around, the price of those things will rise.
Okay.
That's why anytime we see the federal government trying to inject money into the economy to rise it, much like it did after, if you remember in COVID.
Oh, yeah.
In COVID was really not a lot of people, there was a lot of job loss happening. People weren't even going into jobs. And so after COVID, when stuff like that happened, you were seeing the economy really restrict. And so they needed to open up or make that economy a little bit hotter, burn a little faster, right?
I see.
So they had stimulus. They tried to add stimulus
That's
money
right.
into the economy. Or something the Federal Reserve can do is they can buy up those bonds. They can buy those back. And so they can buy those back from the banks because if I buy those back from the banks that maybe bought those bonds in the first place, if I buy those back, then there will be more money for them to give in borrowing. And if they give that money in borrowing, then that money will be out there in the open inside this currency, and it'll kind of put fire onto that economy, make it burn faster, or make it what would be the right words to say? I don't want to use financial terms for this that would be hard to understand, but it makes it more robust, that economy more robust. Because if I say that we're trying to cool down the economy or restrict the economy, people go, why would you restrict the economy? Well, you do need to do that, though, guys, if prices are high.
Sure.
Right? So this is the way they do that. They go, hey, we can either heat up that economy or we can cool it down. We can restrict that economy, or we can make it more open for borrowing, for expansion. We can expand that economy. And so that capability to do that is really left with the Federal Reserve. And the Federal Reserve does that through those interest rates.
Okay, so you mentioned bonds. So if rates go up, what happens to the bond markets?
Yeah, that's a great question. And that's one of the reasons we put that into the title is bonds are critical indicators of a lot of different things. And I'll give you an example. So if we're looking, let's say we're going to say treasury securities is what we'd call them more in the financial aspect, but I'm going to explain it a little more simple. So treasury securities would be T-bills, which are short-term. They would be notes, which are middle-term, and bonds are long-term, right?
Okay.
But the bond market is huge, and it supports so much, whether it's consumers. The bond market is critical for the home market, which consumers care about, businesses who are buying money. You can think of bonds almost like just loans, right? But businesses utilize these, buy and sell these. Banks buy and sell these. Bigger than that, your government utilizes this bond market to pay for their own debt. And what I mean by that is every spring there's going to be a congressional sort of budget that they're going to go over. Hey, the Congress, the president, they're going to get together and go, hey, what does the budget look like a forecast for this year? And they're going to say, hey, we expect X amount of tax revenue to come in, but how much do we expect to spend? And if there's going to be a surplus or a deficit to that.
Okay.
And then that surplus or deficit for a year is going to lead to your national debt. That'll accrue for your national debt. Well, if they can't be in a surplus. And guys, we haven't been in a surplus for a long time, right? So we go into a yearly deficit almost every year, and then that accrues our national debt. But when that happens, we have to borrow that money to pay for that.
Right.
So the way the government borrows that money is they sell bonds. And so they'll sell bonds, and sometimes the people that buy those bonds are foreign governments, or they're investors that buy those bonds. And so what happens is, generally, when we're talking about these things that relate to one another, the bond price will drop. At the same time, the bond yield will increase. And so because those old bonds that were issued, they're not worth as much anymore, and they're trying to increase the interest rate on the new bonds, because they need people to buy those, investors to buy those. Everybody's looking for an investor to buy these. So how do we get investors to buy these? Well, we'll increase your interest rate. But when we increase the interest rates, or the yields, we'd call them, on those new bonds, it's going to drop the bond value of the old ones.
Of course.
So it drops the bond values at the same time, and an increase in the returns or interest rates or yields, whatever you want to call, of the new ones. Well, that's kind of alarming because, or an indicator, because that's why we can look, oh my gosh, we see a lot of countries increasing this yield rate of their bonds. You're going, well, there must be some borrowing issues. There must be something, confidence issues that's happening. And so anytime I see bond yields rising, I'm going, they're trying to get investment. They need investment. And there's got to be something wrong. There could either be the fact that they're, like I said, they're in a deficit,
right,
and not in a surplus, or two, there's not a lot of confidence going on that they can pay back their loans, and so that country can pay back their loans. And so both of those are bad, right?
Sure.
We want confidence to be able to pay back our loans,
right?
And we don't want to have investors, specifically foreign investors, purchasing us owing money back
Correct.
to foreign governments, right? But those are both things that could happen when you are in a deficit, a yearly deficit, or you get too big of national debt. But that's how, watching those bond markets and those yield rates, if those are rising, we're going, wow, that we should take notice of those, or those indicators. I don't know if that.
No, I think it answered.
Is that clear enough? Or?
I think it answered my question.
All right.
Okay, so my next one is, said bonds. When bonds are stressed, how does that affect overall debt?
Yeah, well, I think that's kind of what I was saying, was when they're stressed, when the bond market is stressed, and that yield goes up, it lowers the actual bond price. They're working. Those two things are working together, or they, it's one of those. We talked about what did we call the thinking? Complex thinking, layered thinking. This thing can affect this. Right. Well, the actual bond price will be affected by the bond yield or rates, right? Yeah. So those go together. Or if there's not much confidence in this country or their economy, you know what I mean? you may see a yield spike in the bond market. So a
Okay.
lot of those things are like indicators for us that go, because if there's confidence in it, then the investor doesn't need
Of course, they're not taking that big of
higher
a
interest
risk.
rates,
Yeah.
right? They're not going to give it to them.
That's
They're
right.
like, a lot of these things, it's federal government, it's banks.
Yeah.
They're not going to, these banks, they're not going to give you, high interest rates
Exactly.
unless they need it,
Right.
unless there's a problem. And so that's how they kind of relate
Okay.
to one another.
Okay. So if debt stress grows, what impact does it have on the stock market?
So what's interesting about this, same investors. So we're going to use the same analogy, okay?
Okay.
So here's the investors, and the investors that were there was some little bit of, I don't know, about confidence in the market, right? So they're going to say, I don't know if like you're going to be able to pay this back. That's what the investor, there's got to be an investor that
Yes.
pays these back, right? And then if the investor says, I don't know if you're going to really be able to pay this back to me. So, you know what? I'm going to give you a loan, but I'm going to, if you were somebody that, let's put in another sort of analogy that somebody could relate to. If you had a better credit score, do you know what I mean? I'm just saying,
Right.
which means that you have more, that means I have some reliable data that you're
Right.
going to end up paying this back.
Yes.
Well, I'm going to charge you a lower interest rate.
Okay.
Well, that's not just for you going out and buying a car or that's a country too, or that's anybody who's trying to borrow money, whether that's a country, a business, whoever. If you have the capability, if I look at your financials and you have the capability to pay this back, then I'm going to charge you a lower interest rate.
I see.
Well, it's the same way with an investor. Investors can say the same thing to a country. Our investor can go, hey, I'll loan you money to help you pay back, for your economy, for the spending that you're doing. You know what I mean? That apparently you're not taking enough tax revenue, so that you need to take out these loans. So I'll loan you money, but I'm going to charge you a higher interest rate. I'm going to charge you, I want a better yield. You know what I mean? The same can be said for this correlative investor. We're going to use the same person. This investor saying, okay, well, guess what? Since now, because they're in the shape they are in, and I can get a better interest rate,
Right.
so I get better multiplication on my money in the bond market, which tends to be safer than the stock market.
Okay.
And let's say I normally invest in the stock market,
Okay.
which is a little bit a better return, but a little higher risk. Well, guess what? I now can potentially invest in the bond market with these higher yields, better interest rates now than the stock market. So I can go to a safer market,
I see.
if you will. I don't know if this makes sense.
No, it makes sense.
But I can go to a safer market that's giving me just as good a yields or returns or interest rates. And so, but guess what happens? When that same investor, because you only got so many investors, that's why we're talking about complex thinking. If that same investor now is going to go to the bond market, they're going to come out of the what market? They're going to come out of the stock market.
Yep.
And so if they come out of the stock market, you have less investing in the stock market and more investing in this bond market because of the yields being high.
I see.
So like I said, it's correlated, but one to another, where these things it's complex thinking that these things affect one another. And you could have this issue, this stress. Let's just call these stresses, since we were talking these about little
Tremors.
tremors,
Yeah,
right?
shakings.
Let's call these a stressor,
Okay.
or a stress. So we said the energy stress in the energy market produced the inflation stress, right?
Okay.
And then we said that inflation stress, though, if that becomes stress because of a rise in inflation caused by the rise in energy prices, that inflation stress is going to cause this interest stress, right? Because somebody's got to control inflation, and the only way they control it is through interest rates.
Right.
So this interest rate stress is going to end up, when you're done with that interest rate stress, it's going to create this stress in this bond market, or this bond stress that's happening. Well, once you have this stress in this bond market where they have to raise interest rates to be able to get money and then devalue, or it'll lower the actual bond price, that bond stress market is going to cause stress to the stock market. So these are all coinciding with one another, where you have a potential stress on the stock market, investment stock markets, where people go, maybe these same investors, they're not going to invest in the stock market anymore. They're going to go invest in the bond markets because it's high.
Right.
So it's just why one stressor can lead to another stressor, one tremor leading to another tremor.
I see. Okay. So if the market crashes, what happens to jobs and unemployment?
Right. So the very high thing on this would be the market crashing. And we're not saying the bond market or an increase in bond yields is going to lead to a stock market crash. We're just talking about precursors, or we're talking about little signs and indicators. But I will say something. I just want to say this off the bat is what surprised me. I remember when I was in graduate school a little bit for this, there are always, some camps, and some camps are going to be like, well, we believe, if you invest in the stock market, it's going to be good forever. Or, there's some, another camp that goes, no, look at national debt. I just want to tell you guys a little story. When I was in graduate school, we had this one number. There's always these numbers they would put out. And one of these numbers was debt to GDP ratio. And it was 120%, which means when your debt or your national debt compared to your GDP or gross domestic product was at 120%, that was a huge line where you'd say, there's some warning signs. You say, right? And because we had that happen one time after World War II, we'll just talk in the American economy. And you have to somehow be able to do something about that so the economy doesn't collapse, right? Because there'll be a debt crisis. And so what happened is they raised the highest marginal tax rate on people after World War II to very high, almost 90%, super high on the highest marginal tax rate earners, so they could pay that back, right? And so we don't have that anymore. But look at our debt to our GDP ratio now. Again, if you look at one of these slides here, I'll show you, we're over 120% now.
That's crazy.
A lot of times the U.S. controllers and stuff will say, hey, if you figure in the entitlements and stuff, we're at like 50 trillion. We're maybe at $60 trillion really is the real debt of the U.S. And so if on this slide too, if you'll look, we put some of the debt crises going on around the globe. So it's not just America, but there's debt crises going on around the globe, with just how fast that debt is rising. But in addition to that, what also surprised me is that I still remember when COVID happened, I still remember the stock market dropping almost a third. I still remember it being around, it's been years since I was in school, and it's been years since I paid, in-depth attention to the stock market, but I remember that maybe it was like 29 or something in 2020, but it dropped after COVID in early 2020 or something, maybe later on in 2020, but it dropped to like 19. So guys, it took a huge hit, almost a third of a loss during when COVID happened, and in some of the biggest indexes. And when I say indexes, I mean certain stock markets. And those stock markets, I mean stuff like the S&P 500, the Dow Jones, the NASDAQ. So when you're talking about these huge indexes, there's huge hits to these where it had gotten up to 29,000, it dropped to 19. And so that's what I mean about almost 30 dropping to 20.
Wow.
So about a third of it dropping, which should be huge and should be alarming. But then now when I look, it's only it's 2026 and the stock market's at 50. And I'm saying to myself, I know there's cryptocurrencies and Bitcoins and some huge, inflation things inside the economy. I know when I look at the AI bubble almost, or boost, do you know what I mean? I can say maybe it's in some of these, but I want you to look again at these. I got another slide in here for you that is just something that alarms me a little bit. Like I said, this huge rise in the stock market price, even in the midst of these other things, whether it's energy or inflation. You'll see in some of these slides where I talk about inflation. with the rise of interest rates, we just heard something in the news cycle, I think not too long ago, maybe 3 weeks ago, where the Fed is not going to lower interest rates.
Right.
It's thinking about even potentially it's going to hold them even into 2027 and potentially raise them. And so that means that they don't have a ton of confidence in inflation going down, right? And so, because that's their primary objectives, like we talked about, is keeping control of inflation, keeping control of unemployment. And so those are news cycle things that you go, wow, that's interesting, or should make you go, wow, that's odd. But I want you to look at this one here that I have here about just some of these companies that make up the stock market. I want you to see, so sometimes we have this term where we say market capitalization or market cap. We're talking how big a company is or how much portion they have, either of a market or of the whole stock market. And I want you to look at just these companies here. I want you to look at Microsoft, NVIDIA, and I have them up on the slide here. Apple, Alphabet, Amazon, Meta, just these, what is that? Six
maybe
companies. 6 companies making up $14 trillion of the market.
Wow.
Just in those companies. And look at here in the S&P 500. If you look at the slide I showed you here, 30% of the S&P 500 is made up of just these 6 companies. Or look here at the NASDAQ. NASDAQ tends to be a little bit more tech heavy index. But look at this one, because it's tech heavy index, 53.6% of that whole market cap in the NASDAQ is made up of 53% of it, 53.6% of it is made up of these 6 companies. So that tells me, it alarms me of some things. It's telling me maybe there may be a boom happening. There may be a boom, which is great. And I'm all for booms. Look, I think the internet was a great boom, but we had a dot-com bubble. I think the internet was huge. I mean, how we're doing this is on internet. There's nothing wrong with the internet. I don't have any problems with AI. I think AI is fine. I don't think AI is going to take over the world or anything like that. But guys, a lot of these are AI and tech companies all together. And I'm worried they could be investing into each other, investing with each other. There could be what we would call almost like circular investing. And then we have investing coming from people who are brokers, people in mutual funds, people that pour your 501c3. They're just automatic. We call this sort of like, casual investing. They're just sort of pushing all these to these mutual funds and these things that have these 6 companies in them. And so they're just redirecting these casualties. They're passively, we'll say passive investing. They're not looking at individual companies.
Yeah.
They're just passively pointing everything to these funds that have to do with these companies, which just seems like they're, making each other bigger and bigger and bigger. I mean, look at the size of some of these companies. Look at Microsoft at $3.28 trillion. Look at NVIDIA's $2.79 trillion. NVIDIA, guys, Microsoft been along for a long time, but NVIDIA is just an AI company. Look how big that is. And so it definitely seems like some people are so pushing confidence in this new generation of a thing, almost like they did for internet, this new tech, AI. They're so pushing so much towards this that if there is a collapse, or if it does not produce, or if something happens to these, that it could produce another bailout.
Right.
And what I mean by that is, if you remember, the banks were so critical back in 2008 that the government gets to a point when it's such a huge portion of your economy, when we're talking about the stocks and stock markets and being so essential to your economy, then you have to end up bailing them out. And if you remember, that's what we did back in 2008. Well, guys, what keeps us from thinking that doesn't have to happen with some of these 6 companies?
Exactly.
They make such a huge portion of our markets that they may be forced to bail some of these companies out if they fail. And so I just think that puts you in a predicament in the stock market. And I think those are some things to watch. Those are some things, just little indicators to watch where how can this stock market be growing this fast inside these conditions if there's not something underlying to it?
That's a good point.
If that makes
No,
sense.
it's a great point. It's a great point. Okay, so I have one final question for you.
Okay.
So what things hit the news recently that made you feel the need to do this episode?
So it was the rise in bond yields. I watched Turkey's
The lira?
yeah, the Turkish lira and the currency and some currencies around the globe plummeting. Guys, those are usually a sign. Guys, if your currency is plummeting,
Right.
that's some of those factors we talked to you about in that progression. If your currency is plummeting, there's probably a problem with your inflation.
Yep.
There's probably a problem in one of those things that we talked about here. And I do think the energy market is affecting inflation around the globe. And I just want to keep talking about complex thinking here a little bit, guys. Is what I am not saying is the wars that are going on over there in the Middle East are not worth it. That is absolutely not what I'm saying, because I'm talking from a biblical eschatological background where I prioritize, where
Correct.
I know this is going to happen.
Yeah.
I know the global economy is going to be bad. I know these all things happen before our great blessed hope, the return of Jesus Christ. I mean, so it's almost like you saying, well, this is so bad because there's birthing pains. You'd
Right.
say, well, great, there's birthing pains. That's terrible. They're going to hurt. But guess what? You can get a baby. So
Yeah.
I'm not saying watching, these tyrannical governments, watching Iran killing their own people, oppressing their own people. I'm not just because I know some of the financial and economical stuff of what this is causing doesn't mean that I'm saying that, okay, well, then we should not try to free these people or come against these governments
Correct.
that are shooting their people in the streets and stuff. That's absolutely opposite of what I'm saying. What I'm saying is no, that's okay to do that because the love of most should not run cold.
Correct.
But we should care about others, even if it's at our own, if it affects us,
Yeah.
adversely. But I'm just pointing out these things are why we do the podcast.
Yeah.
Is if you wanted proof of the things that what we're saying is true, look at how much global Islam is rising. I just want you to look at these last podcasts that have happened. Look at the rise in anti-Semitism around the globe. Look at these fractures coming to the global economic community.
Right.
With some of these currencies dropping, with some of these debts still rising, these national debts, with some of these inflation still accruing. You'll see on some of the slides that we put up here, they seem to be growing. Inflation seems to be growing from 25 to 26. Look at these bond yields rising around. These should all give you indicators that there is some economic stress coming. There may be some quakes coming,
Right.
some full-blown quakes coming. But guys, this should give us hope that, guess what? That also means that Jesus is coming.
Come on.
And you should be able to look back at some of our other episodes and go, this may lead to even more wars and rumors of wars
Right.
and geopolitics that may cause even more economic stress. Because a lot of the wars that people get into are because of energy.
That's right.
Are because of finances or, because their government and their currency is dropping and not doing well. And so what do? They'll go to war.
Right.
And so I would just have you look at just how complex all this is that goes in here. And I would say we'd love to do a call to action with you hey, if you listen to the podcast where you say, hey, guess what? I saw this.
Yeah.
I saw in this increase in bond yields. Hey, I saw inflation increasing across these countries. Hey, I saw, the drop in these currencies. Hey, write us in the comments section and say, hey, guess what? I see this happening too, or this happening too in the financial markets. And I want you to be encouraged.
Yeah,
and
amen.
that you say, that's okay, because praise the Lord, Jesus may be coming back even sooner. Or like you said, this firm covenant may be happening,
Right.
or something's going to eventually hit somewhere where you go, very similar to, how would you relate it to something has to hit in the birthing process, does it not, for the baby to come?
Yeah, I mean, there has to be a transition of stuff happening. You know,
Right.
things have to start to increase and intensify and pick up to where you're going, oh, okay, well, this is different. You know, something feels different. Something
Right.
is not as bearable. You know, things become a little bit more unbearable.
Right.
But it's also a sign of things increasing and intensifying
Right.
to get to the end. So
Right.
I would say it's very equivalent.
Yeah, because is there something that has to happen is there something that happens in your body that allows the baby to come out?
Contractions.
Right. And
Tremors.
So there's something that has to happen for
Yeah.
that to happen. And one of these things, if we believe in biblical prophecy like we do, some of this stuff has to happen.
Yeah, amen.
And part of that is economics.
Right.
And all we're trying to say is if you watch this podcast, you'd say, hey, you may want to watch this podcast because guess what? I do see a rise in anti-Semitism.
Right.
I do see a rise in globalism. I do see some financial and economic shocks happening from around the globe. You may want to watch this podcast. Hey, I do see a potential for them wanting to, having a firm covenant so that there's peace.
Right.
So these geopolitics don't continue to shock economies around the globe.
Amen.
So that was the point of the podcast, is to be able to just show you how economics and these indicators can even affect your eschatology.
Amen. Well, I really appreciate you doing this. I know this is a little bit of a shift in how we normally do our episodes, but it was, to me, it's so specific to the headlines. Like we said, we want to bring in those current events, the news cycles, the geopolitics, to correlate it to what we've been talking about this whole time in the progression of things. So I appreciate you putting in the time to do that. It helped me tremendously because I don't understand a lot of those things because you do. I'm married to you, so you help me. So I appreciate that. So I hope it helped the listeners as well. I will say that if you guys have enjoyed watching our episodes, I would really appreciate you continuing to like, comment, and sharing the videos to get them out across the internet, across the world, to help inform people about what we're trying to teach here. We have noticed that about 70% of those who watch our episodes are not subscribed to our YouTube channel. So if you are watching and you want to continue to know when we put out episodes and you want to be notified, to subscribe to our YouTube channel, hit that notification button so you'll know when our next episode goes up. And if you want to know anything else about what we are involved in, to go to our link tree, which is in our About page on our Facebook. It's in our bios on our Instagram and our TikTok. It's you can find our website there. You can have a link to our documentary. You have links to how to support us. And you can have links to our website and where there's more resources for you. So please get involved. We do like the engagement. So continue to comment on all the videos, on our shorts, our reels. We appreciate that. And we'll see you next week for episode 8.
Episode 8.
Yes. So thank you so much for joining in. Join us next week. Maranatha.
Maranatha.
We won't bow to the fear. Every birthday, every shaking says the kingdom is near, is near. You said it long before the fever and the rage. Lift your eyes, I'm with you to the end of the age. When the heavens roar and the skies rolled away, we will rise in glory at the end of the age. At the end of the age. Oh. At the end of the age.